Welcome back to Investing Talk Podcast.
Today we're looking at CORZ Scientific. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, so the main story with CORZ Scientific, it seems, isn't really Bitcoin anymore, is it? It's infrastructure.
That's exactly right. They're making a very deliberate shift, moving away from, the volatility of just mining crypto themselves.
Towards what specifically? What kind of infrastructure are we talking about?
Towards high-margin services. Specifically, something they call high-density colocation, or HDC.
HDC.
Yeah, and this isn't just like renting out shelf space. This is serious stuff. Power-hungry infrastructure built for AI, for high-performance computing workloads. Think massive model training.
Okay, and why is that pivot so crucial for investors? You hear high margin a lot, but what does it actually mean for them?
Well, it's a game changer, really. Their old self-mining business, it's tied to Bitcoin prices, needs constant reinvestment in new machines. The margins jump around a lot, maybe 30–40% gross margins. If things are good.
Volatile.
Very. But HDC, that's different. It's long-term contracts, stable revenue. We're talking potential operating margins, potentially pushing past 65%. It's like switching from selling a commodity to running a high-value utility.
65%. Wow. Okay. And are we actually seeing this shift happen in their financial results?
We are, yeah. If you look at the Q3 2025 earnings, HTC revenue climbed to $15 million.
$15 million.
Yep, up from about $10.3 million the year before. That's a, 45% increase? Pretty solid. Management keeps highlighting this because, well, that's where the growth is. They're actively moving resources over.
And you see the other side of that coin too, right? The self-mining part.
Exactly. The digital asset mining revenue is still significant in Q3, $57.4 million. But the key is the volume, the actual Bitcoin mined. Down big time, 55% lower. It confirms they're in transition. They're taking power capacity that used to run their own miners and giving it to these higher-paying HDC clients instead.
So this whole recalibration, it's starting to help the overall financial picture, even with the cost of building out this new stuff.
It seems to be. I mean, look at the losses. They're narrowing quite a bit. Right. The net loss in Q3 2025 was $146.7 million.
Which still sounds like a lot.
It does, until you compare it to Q3 2024. Back then, the net loss was $455.3 million.
Okay, that's a massive improvement, over $300 million better in just 1 year.
Right. So that tells you a couple of things. One, they're managing costs better. And two, that operating leverage from the new HDC contracts, those higher margins, it's starting to make a real difference.
And their short-term health. Can they afford this transition?
Seems like it. Their current ratio is strong, 1.79x. So good short-term liquidity. They appear to have the runway. But what's really interesting, I think, is how the institutional money is reacting.
The smart money. Tell me about that. Who's buying? Are they really convinced?
The conviction looks pretty strong, actually. Institutional ownership jumped almost 14% just quarter over quarter.
14%? Wow.
Yeah. And you see some big names increasing their positions. Ghislaine Capital, Vanguard. And it's not just small ads. The overall weighting in institutional portfolios shot up nearly 42% last quarter.
42% weighting increase. That's not passive investing. That sounds like active accumulation. They believe in the story.
That's how it looks. And then you check the options market.
Right. What are the pros doing there? Hedging? Speculating?
Betting on the upside, it seems. The put-call ratio is really low, 0.26.
0.26, so heavily skewed towards calls.
Extremely. For every put option bought for downside protection, traders are buying roughly 4 call options, betting the price goes up. That signals some serious professional belief that there's more upside coming, maybe quickly.
Okay, which brings us right to the elephant in the room. The CoreWeave acquisition offer, this seems like the biggest near-term thing, right? And it kind of clashes with all this optimism.
It's the absolute key conflict right now. You've got this company, CoreWeave. They're huge in specialized AI cloud computing, growing super fast.
And they need power. They need the infrastructure CORZ Scientific has.
Precisely. So they made an offer to buy them out. There's a shareholder vote coming up soon, October 30th.
Okay, what's the offer on the table?
It's a stock deal. 0.1235 CoreWeave shares for each CORZ Scientific share. Now, based on CoreWeave's private market value, that works out to roughly $15.23 per share for CORZ Scientific holders.
$15.23. Okay, wait. You said the stock closed recently around $18.
$82.06, yeah.
So the market is trading the stock almost $3 above the takeover price. How does that work? That seems risky. Is it just hype, or is something else going on?
It's definitely a high-stakes situation.
Yeah.
The market is essentially betting that the $15.23 offer isn't the final word.
Betting on what? A higher bid.
That's one possibility. That CoreWeave itself, or maybe another company, a white knight, comes in with a better offer before that October 30 vote.
Or, what's the other possibility?
Or that the shareholders reject the current bid. And if they do, the thinking is that Core Scientific goes it alone, focuses purely on building out this high-margin HPC business, and that independent path could be worth a lot more than $15.23 in the long run.
So the market's pricing in either a better deal or a potentially more valuable standalone company.
That seems to be the calculation, yes.
And there are rumors swirling too, right? About other deals, partnerships.
There is chatter, yeah.
Yeah.
Talk about potential strategic partnerships, maybe with the big cloud providers, the hyperscalers, or other AI players. Deals like that could really blow open their revenue potential, maybe even beyond what CoreWeave offers internally.
And analysts seem to see that potential upside too. What are their price targets saying?
Well, the average analyst target for the next 12 months is already around $19.01, so significantly above the current offer price.
$19.
But some analysts are much more bullish. You see targets reaching as high as $31 per share.
31. Okay, but that high target must assume they don't get bought for $15 and that they successfully execute this big pivot into AI power.
Absolutely. That 31.1 figure implies they capture a really significant piece of the AI infrastructure market on their own.
Let's look at the chart quickly, the technicals. Because 152% return in 6 months, that's some serious momentum.
Huge momentum. And you don't get that kind of move without institutions getting involved, like we discussed. Technically, yeah, the picture looks strong. The stock price is comfortably above both its 50-day and 200-day moving averages. That's, textbook bullish behavior. Sustained buying.
And the momentum indicators themselves, are they looking stretched, overbought?
Not really, no. Things like the RSI, the MAN CD, they suggest the momentum is healthy, that buyers are in control, but it doesn't look dangerously overheated right now. It points more towards steady accumulation.
Okay, so for listeners trying to navigate this, especially with the vote coming up, what are the key price levels to watch?
Right, things could get volatile. So looking at the past 3 months, the stock's basically been trading between, say, $14.50 on the low end and $20.36 on the high end.
So that $20.36 is the key resistance to break through.
That's the near-term ceiling, yeah. If it can clear that level convincingly, especially after the vote, then those higher analyst targets start looking more achievable.
And on the downside, if the deal noise fades or something goes wrong, where's the support?
The main support level looks to be right around $16. That seems like a key area buyers have defended recently.
$16, got it. And lots of potential triggers for volatility coming up, not just the vote.
For sure. You've had the October 30 vote, obviously. Yeah. But then there's also ETF rebalancing coming up in November, quarterly index adjustments. Given how much institutional money has flowed in recently, those index events could force significant buying or selling too. It could really move the price.
Okay, so summing up, we have this strategic shift to high-margin AI infrastructure. The financials seem to be improving. Liquidity looks good. Institutions are buying heavily, suggesting they think the current bid is too low. But we have to talk risks. What could go wrong here?
Absolutely. Risk number one is clearly the CoreWeave deal itself. Like we said, the market's pricing in a better outcome than $15.23.
Right.
If the shareholders vote no on October 30th and another higher bid doesn't immediately appear, well, that M&A premium baked into the current price could evaporate fast. The stock could easily fall back towards that $15.23 level, or maybe even lower in the short term.
So deal failure risk. What else? What about actually doing this big transition?
That's the execution risk. Building out huge, complex HPC data centers, that takes a lot of capital, a lot of time, and very specific know-how. If they run into delays, cost overruns, or if signing up those big AI clients takes longer than expected.
Then hitting those super high analyst targets gets much harder.
Exactly. That $31 target relies on smooth execution. They have the liquidity now, but transforming a business model, this dramatically always carries significant execution risk.
And we shouldn't completely forget their original business either.
Good point. They still have some exposure to Bitcoin price swings, even as they pivot away from self-mining. And another thing is customer concentration.
Meaning too much reliance on just a few big HDC customers.
Yeah, especially early on. If one of those key initial clients decides to leave or scale back, it would put a noticeable dent in that new high-margin revenue stream. Diversifying that client base will be important.
So quite a few things to watch out for.
definitely. But, compared to pure crypto miners, their improving liquidity and this diversifying model probably give them more resilience.
Okay, so it really comes down to a central question for investors, doesn't it?
Ultimately, the investment thesis hinges on which force you believe will prevail: near-term ceiling imposed by the CoreWeave acquisition price, or the long-term structural value created by their growing dominance in the high-density colocation market.